Hey there, welcome. I'm Terry Chantel, financial educator, course creator, and public speaker. I am a financial expert and I help take you from beginner to expert when it comes to keeping, saving, or making more money. So, in this course, you will learn all about the basics of business entities. You'll learn what a business entity is, how they work, and I'll give you some pointers on how to choose one. So, we'll jump right in. A business entity is basically an organized structure created to carry on a trade or a business, and it's separate from its owner for tax purposes. So, in other words, a business entity is a formal structure that says this is a business, it is something separate from me as a person. Now, the three most common business entities that we will go over is the LLC, the S Corp, and the C Corp. Now, one thing that all three of these have in common is that they all provide you limited liability protection. This is one of the most important factors that you need to take away when you are understanding what a business entity is. Limited liability protection limits the financial liability of you as the owner to the value you've invested in that company. In other words, your liability is limited to what is owned by your company. So if you were to ever get sued, if someone wanted to come for your assets, they can only come for what your company owns. Your personal money, your personal house, all of those assets are safe from being liable in a lawsuit. And that is one of the most important aspects and reasons why you would want to form a business entity. Now, there's a reason that I haven't brought up one you're probably familiar with, which is the sole proprietor. Being a sole proprietor is not a business entity. While, according to the IRS, you are considered a business if you are engaging in activity for the sole purpose to profit, you're a business. But when it comes to what a business entity is, a sole proprietor is not a business entity because it does not provide limited liability protection. So, let me explain that a little bit further. So, when you're a sole proprietor, this diagram represents what that looks like. Your personal assets and your business assets, the money you make from your business, they are all one and the same as a sole proprietor. You don't have to do anything formal to be a sole proprietor. All you have to do is say, hey, I want to sell something to make money. The IRS at that point considers you to be a sole proprietor. You're a business. You should file that income on your taxes. It's that simple. But the second you become a business entity where you form an LLC, S Corp, or C Corp, then now you've put this barrier, this veil around your business, and that is that limited liability protection. What that does is it separates your personal assets from your business assets. And so if someone wanted to sue you, they can only sue you for what's within this box. That is what limited liability does. So for now, that's what you know, that a business entity gives you limited liability protection, but also the difference between those business entities is the way they are taxed. So before we move on, let me cover one more important thing with you. Understand the term corporate veil. When you form a business entity, you are creating what's called a corporate veil. That is the invisible, let's say it's a veil, it's the protection that you've put on your business. And in order to maintain that protection, you have to operate in your business under certain guidelines. Guidelines such as you need to have a business bank account, there may be some certain formalities, meetings, paperwork that you have to file based on the business structure or business entity that you choose. Under that corporate veil, you have to respect the rules and regulations of that structure. If you do not, you can risk what's called piercing that veil, meaning, let's say you have an LLC, but you file that LLC, but you still have a personal bank account, you don't have a business bank account, you are operating as if you are just a person without a business. Well, if someone tried to sue you, then it's possible that they could still have access to sue you for your personal assets because you didn't operate in the manner that you should have under the business entity that you choose. That is what we call piercing the corporate veil. So whenever you do choose a business entity, you have to educate yourself and understand the rules of how you're supposed to operate so that you do not lose that limited liability protection. Now, let's move forward. So first up is the LLC. Now remember, I'll go through each business entity based on how that entity is taxed. Here's how the LLC is taxed. All of your income is subject to an ordinary income tax, and that is based on the income tax bracket that you are in. But when you have a business, pay close attention to this. You will have to also pay an extra tax called the self-employment tax, which is about 15%. You need to be very familiar with the self-employment tax, aka payroll taxes. Basically, it's so you can pay your share of Medicare and the Social Security tax. Think about it. When you work on a regular job, not only do you have to pay federal taxes, but you also pay those tax amounts on those other two boxes on your W-2. When you have a job, those automatically come out of your paycheck. But when you have a business, you pay that portion at the time you file your taxes in the form of the self-employment tax. But what stinks even more is that your job actually pays half of that 15% for you. So you really don't pay the whole 15%. But when that money is made from a business, you are responsible for that entire 15%. So when you're self-employed, that's why it's very important that you know about your write-offs and your business expenses so that you can learn how to keep more of what you make to kind of make up for these self-employment tax. One of the things you want to make up for. And I teach all about that in my several classes, including taxes for bosses, and beauty sheets, and several other classes that'll help you keep more of what you make. So just let that sink in though. For the LLC, the bottom line is 100% of your profits are what we call pass-through to your personal tax return, and it's subject to 100% of these payroll taxes. Next up is the S-Corp. Now, the S-Corp works similar to an LLC. So let's run through a scenario though so we can talk about how this is taxed differently as well. So let's say that you made $100,000 in revenue. Now, because this is an S-Corp, you're required to pay yourself what's called a reasonable salary. S-Corps have these rules, and one of the rules says that if a shareholder, meaning you as the owner, works in the business, then you must be paid a reasonable wage. So in this scenario, you paid yourself $40,000 in wages. Those wages are subject to that ordinary income tax and that self-employment tax. Now, the remaining $60,000 is considered your business profit, and it's filed on a separate form called the 1120, and it goes to your personal tax return. But here's the best part. That $60,000 is not subject to the self-employment tax. That is pretty much the whole goal of becoming an S-Corp, because you can literally save thousands as an S-Corp compared to an LLC. So the obvious question after that is, why would anyone become an LLC and not just go for becoming an S-Corp? Well, I'll talk about that a little later because there's a little bit more to it. But in the meantime, you should know that if you are in a profitable business and your income is increasing, be aware of this tax strategy. At some point, you will have to switch over to an S-Corp. And in my 14 years of doing taxes, I can promise you, when people don't know about the S-Corp, they always switch a year, 2 or 3 later, and they miss out on the opportunity to not pay those self-employment tax when they reached a scenario where this business structure would have benefited them tremendously. Now, the C Corp. So with a C Corp, it's unlike the other business structures. It will actually file a tax return on its own, and it will pay its own taxes on that revenue. This is called the corporate tax rate. And right now, at the time of this, it's around 21%. Now, the money will then go to the shareholders or the owners of that corporation in the form of distribution. And then they will each file those distributions on their personal tax return, and they will pay another tax rate called the dividend tax rate on that money. If you heard the term before, this is what double taxation is, because technically the money is being taxed twice. So this is why it doesn't make much sense for a very small business like a one owner business to become a C Corp unless you are just in a scenario where it completely makes sense for you, such as you're trying to go public or something of that nature. So we've covered the basics of each of the entities. So naturally you want to know, well, how should I go about choosing one? So I'll give you some tips on that. Most of the time you're going to start out with an LLC. This is for newer entrepreneurs. It's really easy to form. There's less formalities. It's not that difficult to maintain that corporate veil as long as you just know the simple guidelines. Fairly cheap to form an LLC, and it gives you that limited liability protection. When it comes to the S Corp, as a tax professional, you don't want to base this on income, but I will tell you this. In S Corp, you're usually going to look at that when your net income, meaning after you've accounted for your expenses, I would say around $70,000. And here's why. When you become an S Corp, you do have to maintain it. There's more costs to prepare your taxes. You're going to be visiting your tax accountant probably quarterly. You're going to have to pay taxes throughout the year. There's just more formalities to it. And so although you may save on those self-employment taxes, the amount of money that you're saving has to be a considerable amount more than the money that it costs to actually maintain becoming an S Corp. Otherwise, it's really not worth it. So it's not something I suggest that you just jump into unless you talk to a professional, you look over your numbers, and you know that you have a team in place to help you maintain that S Corp so that you can get those benefits and not pierce your corporate veil as well. And last but not least, the C Corp. And that is when you are in the bigger leagues and you plan to go public. You have a lot of shareholders that you want to be able to have. And on top of that, right now, depending on your situation, you can actually pay less taxes because the corporate tax rate is 21% right now, and that's lower than some of the higher individual income tax brackets. So this is something that a tax accountant can help you decide when it comes to which structure that you should go with. So you know all of the basics at this point about the most common business entities and how to go about choosing one. Now, I have several courses. Startup Boss, Tax for Bosses, Finally Fix My Credit. In Startup Boss, I go deeper into how to form these entities if you're at the place where you are about to get started. So I hope by the end of this course, I have taken you from beginner to expert when it comes to knowing the basics about business entities. Good luck in your business.